Listen up, because there is a massive, glaring disconnect in the market right now. And frankly, if you aren't paying very close attention, you are going to get caught in the crossfire. After the closing bell on July 8th, Levi Strauss Co, ticker symbol LEVI, delivered a second quarter 2026 earnings beat that, by all traditional metrics, should have sent the stock significantly higher. I mean, they beat on the top line, they beat on the bottom line, the internal operations, they looked pristine. Yet, in pre-market trading on July 9th, we saw the stock absolutely plummet. It dropped nearly 5.8%, dragging it down to $22.96.
Yeah, and it just doesn't make sense on the surface, right? I mean, we are looking at a legacy retail manufacturer that actually delivered exactly what Wall Street asked for, and they still got severely punished by the algorithms.
Exactly, and that's why we're here. Welcome to Iron Financial. I'm the lead analyst, and my mission is to help you forge a stronger portfolio and cut through this kind of market weakness. Beside me is the market skeptic, who is here to ask the hard questions on your behalf. Today, we are delivering a complete explainer of Levi's Q2 earnings report. So, if you want to survive these market crosscurrents and stop getting crushed by institutional algorithms, you need to hit that subscribe button right now. We do the heavy lifting, so you don't have to.
Okay, let's dive right into this massive contradiction. Because on one hand, you have a really solid Q2 earnings beat across the board. The numbers are undeniably positive. But then on the other hand, you've got this devastating 5.8% pre-market dropdown to $22.96. So what is actually happening here? Is this just retail hype getting crushed by institutional reality? Are we looking at a classic sell the guidance setup? Or is there something structurally wrong with Levi's core business model right now that the main headlines are completely missing?
That is the exact right series of questions to ask. You see, retail investors see the headline beat, they buy blindly, and then they get trapped when the institutions dump the stock right at the open. To understand this specific price action, we have to strip away the emotion and run a strict, forensic financial breakdown of the actual print. We need to look at the concrete structural strength of the quarter and then contrast it with the cracks in the armor moving forward. So let's get to work.
Moving into Section 1, the top and bottom lines. This is where we look at the concrete structural strength of the business.
Let's get right into the hard numbers. I am telling you, the foundation of this second quarter is made of reinforced steel, not retail hype. Boom! Look at that number right there, 28 cents. That is the adjusted earnings per share actual for the second quarter. The street consensus? They were only looking for 24 cents.
Okay, so that's a solid 4-cent beat on the bottom line. It definitely proves they're actually generating real, tangible profit, not just relying on weird accounting tricks. But in the grand scheme of things, is a 4-cent beat really all that impressive?
In the apparel manufacturing business right now, absolutely. It's huge. A bottom-line beat of this magnitude shows that management has a tight, unrelenting grip on operational efficiency. They aren't just selling clothes, they are flowing that revenue straight down to the bottom line despite massive macro pressures out there. It means their supply chain is optimized and their overhead is strictly controlled. It's a rock-solid earnings beat that shows they're executing on their core business model in a highly volatile macroeconomic environment.
Okay, fair enough. But as you know, a bottom-line beat can sometimes just be the result of aggressive, unsustainable cost-cutting. You fire a bunch of people, slash budgets, and suddenly the EPS looks great for a single quarter. I need top-line context here. Did they actually sell more jeans?
Fair pushback. Let's look at the revenue. Q2 revenue hit $1.56 billion actual, which completely crushed the $1.52 billion consensus expectation.
Wow, okay, so the demand is actually there. But for the retail investors watching this explainer, break down the difference between their reported and organic net revenues.
That's an excellent point to bring up. So reported net revenues were up 8% year over year. But more importantly, organic net revenues grew 6%. Organic revenue is the true measure of a company's internal growth engine. It strips out all the noise, like currency fluctuations and acquisitions. A 6% organic growth rate means the core business itself did the heavy lifting this quarter. People are organically buying the product at a higher volume.
Let's move to Section 2, Forging the DTC Foundation.
Now, to understand exactly how they drove that organic growth, we have to look at the strategic pivot that's being flawlessly executed by CEO Michelle Gass. She is driving a massive transition to a DTC-first denim lifestyle brand. Right, DTC meaning direct-to-consumer, bypassing the department stores, cutting out the wholesale middleman, and selling directly to the end buyer. Exactly, and this pivot is the new durable core engine of the company. Look at this split on the chart. Direct-to-consumer sales accounted for more than half of their total revenue for the first time ever. Wholesale is now officially the minority. I gotta say, that genuinely surprises me. Levi's is a 170-year-old brand,
Their entire empire was built on wholesale distribution. They were the anchor brand in literally every major department store in the world. Is this a permanent structural shift, or is this just a temporary blip because department stores are currently pulling back on their inventory orders? Oh, make no mistake, it is permanent, and it's entirely by design. Hitting that greater than 50% threshold for DTC is a monumental milestone. It means their foundation has fundamentally shifted. It's about owning the customer relationship, controlling their own pricing power, and presenting a full lifestyle brand, rather than just being a heavily discounted rack of jeans in some struggling suburban mall.
And I actually have the specific data points to prove this DTC foundation is rock solid. First, they are successfully expanding beyond just men's denim. We saw an 11% expansion in the women's apparel sector, which, by the way, is a highly competitive space. Women's apparel is crowded, so taking double-digit market share there is a very strong signal that the overall brand is resonating. Absolutely. It proves the lifestyle transition is working. Second, their DTC comparable sales growth, meaning the sales at existing direct channels, grew by 6%. So they aren't just opening new stores to artificially inflate the numbers. The stores they already have open are performing better organically? Precisely. That proves organic, localized demand is incredibly strong. And finally, the digital channel is absolutely on fire. E-commerce net revenues were up an incredible 19% on a reported basis. They are successfully capturing the modern digital-first consumer. So they aren't just surviving the retail apocalypse, they are actively building a digital fortress.
Section 3. Tailored margins and liquidity.
Okay, I'll admit, the DTC pivot looks incredible on paper. But as the skeptic here, I have to ask, at what cost? Building out e-commerce logistics, handling individual returns, and operating your own retail stores is highly expensive. Are these transitions burning cash? Is the business model unraveling at the seams, behind the scenes, just to prop up this top-line growth?
That is a crucial question, and this is where the explainer gets really interesting. To answer that, we have to strip away the revenue and examine the company's margin armor. Despite massive macroeconomic headwinds, specifically tariffs and foreign exchange rates working against them all quarter, their operating model has perfectly tailored margins. Gross margin actually expanded 10 basis points to 62.7%. Wait, how exactly did they manage gross margin expansion with those heavy foreign exchange headwinds? Two things: lower product costs and serious pricing power. Because of that DTC pivot we just discussed, they don't have to share profits with wholesale middlemen anymore. They can raise prices, they can control the discount cadence, and the consumer is still buying. Furthermore, their operating margin rose 35 basis points to 7.8%, and the adjusted EBITDA margin hit 9.0%, which is up a massive 70 basis points. The verdict here: they aren't burning cash to grow. They're actually becoming structurally more profitable as they scale the DTC model.
And if you want absolute proof that they aren't unraveling at the seams, just look at this pristine balance sheet. We are talking about $849 million in cash and cash equivalents, and total liquidity sitting at roughly $1.8 billion.
Yeah, that is a massive cash cushion. It gives them a lot of operational runway. But you know what always catches my eye in these retail explainers? The inventory number, down 7%.
Exactly. In apparel retail, inventory is the silent killer. Look at what happened to broadline retailers last year. They were completely crushed by clearance markdowns because they over-ordered. A 7% decrease in total inventories on a dollar basis year over year proves that management is running a tight, highly disciplined ship. They are matching supply perfectly with demand. They aren't overproducing, they aren't tying up cash in warehouses, and they definitely aren't going to be forced into massive margin-crushing clearance sales next quarter. So the balance sheet is a fortress. The margins are tailored perfectly. The inventory is lean, and the revenue engine is firing on all cylinders. What does this concrete structural strength actually mean for shareholders who are holding the bag right now?
It means you are getting paid to hold. Management loudly spotlighted a 14% quarterly dividend increase, bringing it to 16 cents per share. On top of that, they have a $200 million accelerated share repurchase program that's expected to settle in the third quarter. They are aggressively returning capital to shareholders. Doing stock buybacks while simultaneously expanding your business is the ultimate sign of a durable core engine. They have the concrete structural strength to reward investors right now.
Section 4. Cracks in the armor. The guidance drop.
All right, lead analyst. I've let you build the bullish case. You've painted a picture of a flawless, reinforced steel operation. But I'm taking the wheel now. If the foundation is so incredibly strong, why did the stock plummet nearly 6% pre-market? Wall Street completely rejected this print. Where are the cracks in the armor? Well, this is where we pivot from looking at the rearview mirror of Q2 to looking through the windshield at Q3 and beyond. The market doesn't pay for past performance, it pays for future expectations. And the future expectations is exactly where the structural trap was triggered. Let's walk through this meticulously. Step 1. In Q2, they delivered 8% reported growth. Fantastic. But Step 2 is where the armor completely cracks. Management's guidance for Q3 revenue growth is sharply slowing down to between 4 and 5%. That is a very significant deceleration. It is a deceleration, for sure. The forward macro consumer environment is clearly showing signs of fatigue, and management is responsibly baking that into their projections. And it gets worse in Step 3. They raised their full-year adjusted EPS to a range of $1.46 to $1.52. The midpoint there is $1.49. But Wall Street's consensus estimate was $1.51. They practically missed the full-year consensus by 2 pennies on their own newly raised guidance. That is exactly why the institutions dumped it. Are we really saying a 2-penny miss is just noise, or is this a sign of underlying structural weakness? Wall Street threw a tantrum over 2 pennies, because algorithms trade on strict consensus parameters. But from a structural business standpoint, management is just being exceptionally conservative in a highly unpredictable global economy.
And speaking of that unpredictable economy, then there is the massive fog of uncertainties surrounding the macro trade environment. CFO Harmit Singh explicitly stated that their guidance assumes U.S. tariffs on imports from China remain at 30% and rest of world at 20%.
This is an absolutely crucial point for anyone analyzing apparel manufacturing right now. Strictly from a financial modeling perspective, the evolving trade environment makes it virtually impossible for Levi's to price in any potential tariff-related benefits. They are being forced to model in these heavy 30% and 20% tariff burdens.
Right. Those tariffs act as a massive, heavy weight on the global supply chain. If policies change down the line, it could be a massive tailwind. But right now, management has to forecast defensively.
Exactly. And that conservative modeling might actually be their hidden strength. They are under-promising now, setting the bar low, so they have the structural capacity to over-deliver later.
Which brings us to Section 5, the final verdict. Okay, it's time to step back and weigh the entire structural blueprint of this earnings report. On one side of the scale, we have the durable core engine of the Q2 beat, the impressive DTC transition, expanding margins, and that pristine $1.8 billion of liquidity sitting on the balance sheet.
And on the other side?
Well, on the other side, it's weighed heavily against the structural trap of the slowing Q3 guidance, dropping to 4 or 5%, the full-year EPS missing Wall Street consensus by 2 cents, and the dark cloud of tariff uncertainty. This is a classic, violent battle between strong micro-company execution and a weakening macro-consumer environment. So, with the stock taking this pre-market beating down to the $22 range, what is the ultimate play for the retail investor? Lead analyst, here is your Iron Financial definitive verdict. The weakness in Q3 guidance is absolutely real, but it is purely macroeconomic noise. The structural foundation of Levi Strauss has never been stronger. They have successfully executed the heavy lifting of transitioning to a high-margin, DTC-first lifestyle brand. They have $1.8 billion in liquidity, shrinking inventory, and they are aggressively buying back their own stock while paying you a 14% higher dividend just to wait out the volatility. Wall Street algorithms sold the guidance miss, but for the focused investor, this pullback isn't a trap. It is a reinforced steel buying opportunity to acquire a durable core engine at a temporary discount. Do not let the market cross-currents shake you out of a fundamentally strong business. Market skeptic, the reinforced steel is clearly there, but are you willing to step into the crossfire to grab it while the institutions are aggressively selling? Is this 2-penny miss enough to scare you away, or are you buying the dip alongside the share repurchase program? Let us know your specific strategy in the comments down below. Hit that subscribe button to keep your portfolio forged in iron, and we will see you on the next explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.